I'm going to show you the best way to earn a passive income on your crypto assets by utilizing decentralized finance. And no, this is not investing your Bitcoin into some mining scheme or investing your Ethereum into some staker that's paying you 1% per day, because that stuff is unrealistic. What we're going to be diving into today is something called DeFi liquidity pools, because people are trading different assets. We all know that. The crypto market's down today. Last week, the crypto market was up roughly 10 to 15%. But with those rises and those falls come trading volume, where people are executing one trade for another. So they're trading, say, Ethereum for USDC or USDC for Ethereum or Ethereum for Bitcoin. Well, in order for those trades to be executed, there has to be liquidity. So that's exactly where liquidity pools come into play. And today, I'm not going to be doing a huge deep dive into what liquidity pools are, but we are going to go over the high-level overview of them and how you can implement these into your portfolio. So there's three different parties in this scenario. Number one is the liquidity pool. Number two is going to be the trader that's trading out of this liquidity pool. And number three is what makes it all possible, which is the liquidity provider. And they're the ones that are putting capital up into this liquidity pool to allow people the ability to trade. So essentially, this liquidity provider is going to put two assets up. Let's just say this is an Ethereum to USDC liquidity pool. This liquidity provider is going to put Ethereum, and they're also going to put USDC in the liquidity pool. And now there's liquidity giving the trader the ability to trade. So the trader might come over here and say, hey, I want to trade my Ethereum for some USDC. That would basically mean that they are selling their Ethereum for USDC. So they're going to put Ethereum in the liquidity pool, and they're going to take USDC out of the liquidity pool. But here's the catch. An automated market maker is going to automatically adjust the price of Ethereum and essentially say, hey, we have more Ethereum in this liquidity pool. We have less USDC in this liquidity pool. That means the price of Ethereum in respect to USDC is going to go down because there's a greater supply for Ethereum and a lower demand for Ethereum. But additionally, this person might put up, let's just say, $1,000 worth of Ethereum, and they might take out $999 of USDC. That additional $1 is going to go to the liquidity provider over here, the person that is making all of this possible. And that's going to be paid out to the liquidity provider in the asset that initially got inputted. So in this case, Ethereum. So that now looks something like this. Liquidity provider going to supply both assets into the liquidity pool. The trader is going to trade one asset for another asset. So let's say it's $1,000 of Ethereum. They're going to trade $1,000 of Ethereum for $999 worth of USDC. That additional $1 is going to go to the liquidity provider paid out into Ethereum for supplying their liquidity and allowing this trade to happen. Now the thing is, $1 is not a lot, but at scale, when there's billions and billions of dollars of volume every single week, these $1 start to add up. Now, if we were to look at the opposite side of things, where somebody was trading USDC for Ethereum, it's the same exact thing, except it's vice versa. You know, they're putting in $1,000 worth of USDC, and they're taking out $999 worth of Ethereum, and $1 of USDC is going to the liquidity provider. It's just, in this case scenario, the automated market maker is going to adjust the price of USDC in respect to Ethereum, allowing for the price of USDC to go down in respect to Ethereum. Which sounds kind of silly because USDC is a stablecoin, so when we look at the other end of things, the price of Ethereum is going to go up in respect to USDC because this trade is happening. There is now more USDC in the pool and there's less Ethereum, therefore pumping up the price of Ethereum. So this right here is exactly how automated market makers as well as liquidity pools work. Now let's talk about some different liquidity platforms that you can provide liquidity on. Number one is Uniswap, and this is the platform that I'm personally most active on, simply due to the fact that they currently have $3.7 billion worth of liquidity invested into their platform, and they have billions and billions of dollars of volume every single week. Additionally, another huge benefit to Uniswap is they are the ones that have invented decentralized exchanges and automated market makers all the way back in 2017 and 2018 when DeFi first started becoming a thing. As well as throughout their existence, they have had zero exploits, which means zero money has been stolen from the Uniswap platform, and they are truly decentralized, run by a governance platform. Now, as you can see on the Polygon network alone, I have had a lot of different Uniswap v3 positions over here, but this one right here is Matic to wrap Bitcoin. I currently have about $15,000 worth of liquidity deployed into this position, and fair warning, it has been deployed for roughly a week. I am getting roughly 35% APR in this pool, but I have been able to collect roughly $800 in overall fees since then. That is really, really good, guys. That's $800 for free that I wouldn't have had if I was just holding Matic and holding wrapped Bitcoin in my wallet. Now, obviously, there are risks associated with liquidity pools, like impermanent loss. But once again, we're not going to dive too deep into that because we do have videos on the channel. And by the way, if you guys have found this video helpful so far, drop a like and subscribe with notifications turned on. Additionally, if you guys do want to learn more about concentrated liquidity pools and how you can leverage up without liquidations and earn APRs of anywhere from 60 to 80% per year on blue chip assets, we do have a Uniswap v3 mini course that is literally only only $40 and it's linked down below in the description. This teaches you everything you need to know about the basics of Uniswap v3, and then from there you can proceed further and potentially work directly with myself. But of course, hopping back into things, there are some other platforms that you can provide liquidity on, stuff like Curve Finance. But the thing is, Curve Finance has been exploited in the past. As well as you can see, the TVL has been dropping a ton, down 13% in the past week. Additionally, the TVL has been dropping a decent amount. It's down 4% in the past 7 days compared to Uniswap being roughly stagnant. We can also look at other decentralized exchanges like PancakeSwap. PancakeSwap is another liquidity platform that you can provide liquidity on. It's a decentralized exchange, but here's the catch. PancakeSwap is a direct fork of Uniswap v3, just a different user interface and some other cool little features. So they also have some very good returns over there, and they have not been exploited quite yet. But what I'm most fond of is by providing liquidity for different blue chip assets, or just assets that I personally believe in and that are going to do well in the long term. So for example, let's just say that is BNB and USDT. Well, then I'm going to go over here to add v3 liquidity. I'm going to select BNB and USDT, select my fee tier, and then from there I can select the price that I want to provide liquidity on. Now, normally I could provide full range liquidity, and if I provide full range liquidity, well, the APR is only roughly 2.85%. It's not too good whatsoever. However, if I were to even do a range of, let's just say, $250 to, let's just say, $350, you can see my APR instantly skyrockets to 35%. That's exactly what concentrated liquidity does. It allows you to leverage up without getting liquidated. The only catch is your assets are going to be converted into each other, which already happens on full range liquidity. It's at a much minor scale. But the thing is, our Uniswap v3 course covers everything related to concentrated liquidity as a whole. Yes, it is tailored to Uniswap v3, but the strategies can be applied to Orca, a decentralized exchange in the Solana network, or even PancakeSwap. And that's because all these platforms are very similar, and they follow the same exact mathematical equations. But I want to dive deeper in how you can take your existing crypto portfolio and deploy capital into concentrated liquidity pools to earn passive income. So the first thing I want to lay out, if you are looking to earn passive income, you are not going to want to go with a super tight range on your concentrated liquidity pool. Because once again, you want to earn passive income, you want it to be passive. And granted, nothing is 100% passive, but at the same time, having a broader range is going to allow it to be more passive than having a much tighter range. So if we look at Ethereum to USDC over here, if I had a range of roughly, let's just say 2150 USDC per Ethereum to something like 2440 USDC per Ethereum, I'm getting 130% APR on this liquidity pool. And granted, once again, there is that impermanent loss risk that is attached. But if I go with a broader range, you can see I'm getting roughly 60% on my Ethereum. But the thing is, this is going to be much more passive because this range right here encapsulates the past 30 days worth of data. You can see this chart is within our bounds right here. Whereas if we tighten up and we go something like this, you can see the whole chart isn't in our bounds. Only periods of the chart are in our bounds. And over here, when we're out of range, we are no longer earning passive income, but we also have a lot of impermanent loss at those case scenarios. So I have a few assets that I'm personally very bullish on, and one of them is going to be Matic. So the first thing we're going to do is head over to CoinGecko, and we are going to search for Matic, or another case scenario, the token that you're bullish on. You want to look at contract right here, and you want to find the networks that Matic is on. In this case scenario, Matic is on the Ethereum network, but it's also on its own network called the Polygon network, or the Binance Smart Chain network, and some of these other networks. So we can look at Matic on number 1, the Ethereum network, and number 2 on the Polygon network. So first thing I'm going to do is look at it on the Polygon network. We have Matic right here. Once we click on Matic, once we pull up Matic, or the token that we're bullish on, we can essentially see all the pools for that asset. Just wait for it to load up. Now, as you can see, all the pools over here have pulled up. We have Matic to Ethereum, we have Matic to USDC, another Matic to Ethereum, a Matic to Link, and all of these different pools. These are liquidity pools that we can provide liquidity for. But the thing is, some of these liquidity pools we're not going to want to provide liquidity for, and that's because the volume to TVL ratio is not good. As you can see over here, this pool has $740,000 of TVL, but it only has 175K of volume in the past 24 hours. That's not too good whatsoever. We ideally want to look for similar volume to TVL ratios, if not higher volume than TVL. Now, personally, I'm also bullish on Link. So this pool right here, Matic paired with Link, stands out to me because, of course, we're going to have exposure to both assets. If we provide Matic and Voxel, we have exposure to Matic and Voxel and underlying price changes to those assets. So if both those assets go up 10%, our liquidity pool goes up 10%. They both go down 10%, our liquidity pool goes down 10%. We also have the fees though. That's exactly why there is a huge benefit here. So let's just say it's Matic to Link, because I think that pool is somewhat decent. I'm going to go over to Builder Metrics. I'm going to pull up the Polygon network, or the network that you find the pair on. You're also going to pull up the pair over here. So in this case scenario, Matic and Link. and then I'm going to select the fee tier. Now, what exactly is a fee tier? This is the tier of fees that people are charged. So if it's 1% on a $100 transaction, well, then they're going to pay a $1 fee. On a 0.3% fee tier, they're going to pay a 30-cent fee. On 0.05%, they're going to pay 5 cents. And on 0.01%, they'll pay 1 cent. Now, the thing is, a lot of people will be like, okay, well, I'm just going to go put my money on 1%. But the thing is, if you put your money on 1%, not a lot of trades are going to be routed there because the Uniswap interface will automatically route you through the best trade route. So for example, if we go over here to Matic to USDC and we trade 100 Matic for USDC, we can expand this, hover over Uniswap API. You can see it trades my Polygon for USDC through the 0.05% fee tier. So that's just something to keep in mind, right? It's not going to go through the 1% fee tier. Now, if I'm doing a very large trade, it might route some of it through 0.3%, or it might route some of it through other fee tiers. It's just going to make sure you get the best possible trade route. But now that we have it pulled up on Builder Metrics, I'm going to select the fee tier on 0.05% because that's where the majority of the liquidity is. So that's most likely where the best returns are going to be. And then from here, I can select my price range. Now, something that I'm going to note right here, since we are not looking at Matic to USDC or Link to USDC, dollar values are somewhat irrelevant in this scenario. This chart does not represent dollar values. It represents how many Matic it takes to equal one Link. And that's because we're looking at Link/Matic, base/quote asset. We are being quoted in Matic. Now, if we hit toggle pair, you can see we're looking at how many Link it takes to equal one Matic. So what that means is if Link is at, let's just say, $15 and Matic is at $7.50, the price of that pool is going to be 2 because it takes 2 Matic to equal 1 Link. Now, if Matic's at $5 and Link's still at $15, the price is 3 because it takes 3 Matic to equal 1 Link. Makes sense? Simple division. So over here, we're looking at how many Matic it takes to equal 1 Link. So we'll look over here. We might do a range something like this, where we encapsulate the past 30 days worth of data, just drag our min price and max price like this. This essentially gets us a 43% yield. Or if we want to be a little bit more passive, we can broaden this just a little bit. That gets us roughly a 35% yield. Lastly, I'm going to disclose is you want to put up the majority of your capital in the asset you're more bullish on. If you're more bullish on Matic, put up the majority of your capital, so like 60% of your capital in Matic, as opposed to putting it up half and half. Or if you're bullish on both equally, then put up about half and half. Now, the thing is, you can't just say, hey, I want to put up this much Matic and this much Link. The ratio depends on current price, min price, and max price. So you can see as I drag my min price, I'm starting to put up more Matic, whereas if I drag my max price, I'm starting to put up more Link. So the thing is, you just need to play around with it to see what works, and you need to try it out. Personally, I think the Matic Link pool is a relatively blue chip pool, and I would be happy to provide liquidity in here for a 38% APR because both Link and Matic are very, very blue chip assets with multi-billion-dollar market caps. Now, the other thing you could do if you want to, it is a little bit more riskier, but you can leverage up over on a platform called Yielder. Now, I currently have a 2x leverage Ethereum to USDC position on here, and it's doing a lot better than if I were to just provide liquidity for Ethereum and USDC separately. But that's the basis of my concentrated liquidity strategy and how I earn passive income through my crypto assets. I know it seems like a lot of work at the very start, and it's very, very hard to understand, which is somewhat true. It's not a crazy amount of work, but you do have to learn exactly how to do this and play with some trial and error capital. And what I mean by that is don't deploy your full bag just to start with. Deploy a very, very small portion of your portfolio. Once you get that proof of concept, start to scale in. That's what we do with all of our clients. Make sure things work before you deploy all of your capital. And once again, if you guys do want to dive deeper into Uniswap V3, mini course is linked down below in the description. It's only $40 for a limited time. I hope you guys enjoyed. If you did, drop a like, subscribe, notifications turned on. I'll see you guys in the next video. Peace out.